Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to dive in there, take a look, see what people are sharing, and I'll share my opinions too. You want to follow me at Finance, and if you want to join our community, finding-value.com, where I dive deeper into all this stuff, looking for potential investment opportunities and sharing that with everyone in the community, and also doing a lot of looking at history and macro uh, market condition environment stuff. So we're going to start with Jordan. Says another gold analog chart I whipped up. So gold's performance after it breaks to new all-time highs. It's a non-log scale, which is important, in the analysis in TDG premium this weekend. So gold all-time high breakup. So when it breaks to a new all-time high, this is where it could potentially go. We've got 2024 breakout, which is the black line that you can barely see there, that is overlaid on top of all the others. The average is this dotted line that's coming on up. The average would put us at about $6,000 an ounce. That's what we're seeing on the left-hand axis here, the y-axis. So, and that would put us in about August 20th of 2025 is what the average duration is. If it follows the 1972 breakout versus the 1978, and I can't tell which one's which, I think the 78 breakout is this one that goes more vertical, and the 72 breakout is the one that goes here. But if it did something similar to those, the ultimate breakout would be about $9,000 an ounce and about $9,000 an ounce. And then the red, the 2007 breakout, gets us at about about $5,000 maybe. But maybe $5,000 an ounce. Obviously, this one took a lot longer in 2007, and then these were much shorter in duration. This one being potentially August of 2025. This one here would be in 2026, 2027, right on that cusp. So those are previous bull markets. That's how much they moved and the time frames that they did it in. Where do I think it's going to go if someone were to ask? I'm not exactly sure. I don't know how long it's going to last, and I don't know how big it will be. If I were to make a guess, I think we're going to go way up. I think we're going to go up to like $10,000 an ounce, $9,000 an ounce, something like that with gold. And it depends on the market conditions and how scared people get in the system. If people get very scared, we could see that go way above $8,000 or $9,000 an ounce. Very possible. Coming down to Peter Schiff, if you thought inflation was bad when the Fed claimed to be fighting it, wait until you see how much worse it gets now that the pretend fight is over. Well, they also have to do two things here. They look at inflation rate, but they also look at unemployment rate. The unemployment rate has been increasing. So we're in a weird situation here where inflation is still going, and we've got unemployment going up with it. That is AKA stagflation. And this is where things become really interesting. This is also where gold rips like no other. It's under that market condition that gold and silver. I think silver is so primed for a huge move, given the market conditions that we're seeing here with unemployment and inflation. Geiger Capital. So looking backwards, this was after the first rate cuts and the performance of the S&P 500. So the first rate cut occurred January 3rd, 2001. The S&P 500 fell 40% the next 448 days. Unemployment rose another 2.1%. In 2007, that first rate cut was September 18th, 2007. The S&P fell 54% the next 372 days. Unemployment rose another 5.3%. I think something like this is going to be similar. I don't think it's going to be like 2007 here. This was a real estate market crash. I don't think we're going through a real estate market crash. We can also look at home builders continuing to go up. So that is off the table, in my opinion. I think it will be similar to 2001. And I do think that this pullback could very well mimic this type of movement, in my opinion. You can also see every single time we've had the unemployment rate go up like this, it has resulted in a recession almost 100% of the time. Well, it is 100. One, there. Yeah, 100% of the time. So we have turned, we are heading higher in the unemployment rate. We still have inflation that may not be at target levels, and they're going to have to make a decision, the Federal Reserve. And the decision they are making is to lower rates, save the economy slash employment. And they're going to let inflation probably run. Kurt says, every time we see an inverted yield curve paired with a flattening Fed funds rate, the US economy is heading into a recession. When the Fed starts cutting rates and the yield curve flips positive, we're on the brink of a recession and a major market crash. This market currently has an 85% correlation to the summer of 2007. This time is no different. So every instance of an inverted yield curve coupled with a prolonged sideways trend in the Fed funds rate, the economy has been heading into an economic recession. He is right. He is right. This is the time where I would start to get more defensive, not aggressive. It's a difficult call because we still have inflation that is lingering in the system, and we've got unemployment going up. So there is the possibility that inflation continues higher and we get a slowdown. It's a combination of those two things. That is called stagflation. In a stagflationary environment, does oil go up or down during a recession? I would err to the side of it going down, not up. But we'll have to wait and see what the charts tell us. And we'll have to wait and see if we get a break to the upside or the downside. This is also prime time for a false flag event to occur. They're going to blame it on something. 9/11 occurred when the yield curve was dropping. So did COVID. And so will something else that is coming ahead of us. If that event occurs, you now know the extent that these people are willing to go to. So something is probably coming. I don't know what it is. It may have been a part of Trump and what they were trying to do with the assassination of him. That could also have been a event that occurred with the yield curve dropping. Stuff like that seems to always occur when people are already positioned, the big money is already positioned in bonds somehow. This is a bad signal for the state of the economy. US diesel consumption has fallen below its 5-year average by minus 245 MMB, even though the chart says 225 over the last 3 weeks. Maybe add it all up, but there it is dropping. But we've also seen this drop. This is 22, 23, 24. This could be the slowdown that we are going through, and they're just trying to hide the slowdown. We're probably already in a recession, and the unemployment rate has probably already triggered everything. They're just hiding it. That's probably my guess. The real Norseman. So the Fed pivot is here. Size and pace is to be determined. My expectation is a fast clip incoming. Iron Dome holds through the pivot has been my expectation. So here's the Fed funds effective rate. You can see when they lowered rates, and you can see the Fed pivot and the move in the S&P 500 index lower in the 70s, 80, 90s, not really too much there, 2000s there, and COVID. So every single time the Fed pivots, we get these pullbacks. Now, some people are saying, uh, quote, I know a lot of people follow the real estate cycle and whatnot, and land values and all that stuff. But if the Fed funds rate goes down, they're generally lowering it for a reason. And that reason is generally a slowdown in the market. That's why they're pivoting, aka the pivot. Stand back, nothing this dumb has been tried before. So global easing way up here. And every time we've got global easing, we have gone up. I know some of the things to think about is they need high stock prices because it increases tax revenues. So maybe they need that to continue to come in to increase tax revenues, given where we're at in our deficit spending and debt. Maybe that's one of the reasons. But they're going to try it when it's at all-time highs here, and we'll see what occurs. Peter Schiff, the Fed was wrong that inflation was transitory, and it's wrong that it's now headed back down to 2%. The Fed is about to cut rates under the pretense that it won the inflation war. The real reason is an attempt to mitigate the collateral damage. Inflation will soon run away. So we've got a couple of things going on. Maybe we do have a slowing down of the economy. We see that with diesel demand. We see that with unemployment rate going up. But inflation may not be under control. So this is the stagflationary environment. That's basically what we're going to live through. And you know what does real well? Gold and silver. They absolutely rip it in these types of conditions. Commodity prices, where to go from here? We're coming from a low level, and we're most likely going to go way, way up. And we may go up for a long time. We've got this, he's got up here 2045 is the estimate. So maybe we have a long way to go in commodity prices and a long way to go time-wise, not just price-wise, but time-wise. Patrick Karam says the trend line game is a nuanced one. Understanding the different probabilities attached to each scenario is a key component of a trader's responsibilities. The way it's got the quarterly gold price versus the SPX, it's a ratio chart. And I not necessarily looking at potential outcomes of where price or the ratio could go. I look at what is driving this. So if we do get a slowdown and we get stagflation, in my opinion, gold's going to go up in that type of market condition. The S&P 500 goes down in that market condition. So that's where the ratio is going to go up. We've already broken the downtrend line for that to basically occur under. So the market conditions are changing is what this is telling us. And this is data of that opinion about the market conditions. And then you can go look at a whole bunch of different data too through charting. And then you come up with an idea of what's coming. We've got Sahara here. Here's the URA update. I said I warned of a coil at the rim, and it moved down after a fake pop to the upside. Dropped back to test its monthly 20 moving average. Now, recovering after slash production targets announced at Kazatomprom. So all of the charting is still intact for uranium. The big question that we all have is, are we going to go up in a recession? And that's the mixed signal that I don't think people really know. And I don't know either. So I'm positioned for both outcomes. For a recession and we go up, and for a recession and we go down. I think the recession that is coming is kind of baked into the cake now, at least in my view, that the Fed funds rate is going to drop. It's like they're admitting that a slowdown is coming, the way that I view it. Grady says, posted this ratio chart among many other charts back in February and March, saying the next big up move in precious metals miners was starting. It was. It was also the historical turning point for precious metal miners versus the stock market. So GDX versus the SPY, and this is a very probable false breakout. To buy down here, guys, is like the buy of a lifetime. Because if it is a false breakout, we just bought the bottom, which we did. And we're going to start heading higher, and it's going to go across this entire thing and break to the upside. Where we'll see a big outperformance of GDX versus SPY. Now, when does GDX outperform? In a stagflationary environment. Why is that? Because oil prices are low, gold and silver rip, and you net the difference between the two. That is the margin of the miners. So I think the mining companies could do some incredible things here if that condition comes that I think is coming in the shorter term. Mr. Uppy says the party is only just beginning. The divide between the price of miners and gold is way too large. Almost all projects are economical. There will be an insane transfer of wealth to those who invest now. I'm already in this stuff. I'm ready to rip. If you look really close, you can see that pattern there. That pattern um, exists right before big moves. The pattern here is angled slightly lower. And it's the same pattern before big moves. We also see this pattern here that's being developed in other sectors as well. So I think we have a big move ahead of us for the mining companies to catch up this gap. This gap is when you do the ratio, it's the gap between the two. So it was real close in the 2000. So we had a big gap in 2001, and it closed the gap as we went up. And then it diverged again and diverged hugely in 2016 onward. So we've got this gigantic gap, and if that gap closes, guys, the miners are going to move big and potentially fast. Josh says we're firmly in oil supply destruction pricing territory. Oil's bimodal price history is worth considering. So supply destruction pricing, he's got 75 or current price is 73.50 right there in supply destruction. Demand destruction is all the way up in the probably 120, 130, 140 range. That range up there. So we are firmly in supply destruction pricing. Depressed options trader, he says we're in the process of one of the dirtiest double tops in the S&P in the last 25 plus years. I've never seen a setup that's cried out sell it all like this in my entire 30 years of trading. Be careful out there. And why, I just went through all of those previous posts. Though that's the setup. The setup is the inverted yield curve, the uninversion of the yield curve, and how these things are trading and the patterns that they are creating. Calvin says, I always chuckle when people say, don't buy this commodity producer. They lose money at these prices. Amigo, that's exactly when you should be buying commodity producers. And that's where a lot of people struggle. They look at history, they look at the last 5 or 10 years, they're like, well, this company's way down. And you're like, yep, it is. And they're like, the 5 year is absolute garbage for returns. And I'm like, yep, exactly why we're buying it. And it's like they don't register. They look at previous returns and try to project forward from previous returns. That is not how you want to do it. The way you want to do it is you need to find stuff that's cheap. And that's where these commodity companies aren't going to be making money because that's when they're cheap. They're cheap when they don't make money. They're expensive when they make gobloads of money. And that's where you have to sell. You have to sell when the 5 and 10 year looking backwards looks fantastic and everything's overvalued. You have to reconfigure the way that you're looking at the markets and how you evaluate things, is what I'll say to those. Here it comes, folks. This is a U.S. total housing inventory. It's starting to come up, and maybe we can break the downtrend line. Maybe we do get a little bit more inventory, and he's obviously joking to some degree because this guy says, here comes the active listings. Yeah, it's flying higher. We're just way up there, killing it. Compared to 07 and 08, we are light years away from that. we're not even at the bottom of those markets. Like, we are so low that we're not the bottom of those previous markets. Brian G says, by several measures, XLU is the strongest sector, which is the utility sector, while XLE, energy, is the weakest. What's that saying about bonds, TLT? So this occurred when we had slowdowns in the system. We have broken that downtrend, are starting to work our way on up. That's a double bottom, starting to work higher where utilities are starting to outperform energy. You know when that occurs? At the beginning of a slowdown. That's where it occurs. For natural gas, the market's doing the right thing, which continues to pull back on production, continuing to do that. And that's what we've got for today. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We do have a 5 p.m. Sunday question and answer session coming up. Love to see you there. And we'll catch you guys later. This is Finding Value.